again to Hidden Truths. And today we have Bob Barone, our host. Hi, Bob. How are you doing?
I'm doing very well.
Good, good. Right. There seems to be some type of interest rate war going on out there. Can you speak to this?
Financial markets and the Fed seem to be at odds. Financial markets now recognize that we have a recession, even though today's GDP number didn't say that. But it's either here or coming. It's the market's view that it's time for the Fed to stop tightening and then to begin to lower interest rates. If the Fed isn't going to do that, the markets can do that for them. It's not like the Fed's going to like it. And the Fed does care. If they didn't care, they wouldn't be sending out the board members with hawkish comments. So we have a chart that shows the 10-year Treasury note, and note that it peaked on October 24th at a 4.25% rate. And then it peaked again in November, almost there at a 4.21. And then in late December, it peaked again at a lower rate, 3.88. And that's on the left-hand chart. The right-hand chart is similar for the 2-year. I won't go into the numbers, but you can see that these charts are similar with 3 different peaks. And note that the peaks are lower each time. So there's a downtrend in the peaks. And as we speak, the yields are even lower today than what's on the chart. The 10-year is at a 3.5% rate and a 4.19% for the 2-year. And that's well below those recent peaks. And this has occurred despite the Board of Governor members attempting to jawbone the rates higher. That is, going out and speaking and telling everybody that they're going to continue to raise rates. There is probably 100% chance that they do raise rates in February, early February 1st. We think by 25 basis points. And that would raise the federal funds rate to a range of between 4.50 and 4.75. It is currently at 4.25 to 4.5 right now. And we think they'll promise to raise rates further to 5% in the meeting, but we don't think that's going to occur because the economy is weakening.
So I recall that in a podcast you did several months ago, you postulated that the Fed would have some trouble controlling the yield curve when it came time to pause rate hikes. And it looks like this is actually happening, right? Would you care to comment further on that?
Yeah, so several months ago, I think in this podcast series, we did postulate that in today's new era of what we call Fed transparency, I'll put that word in quotes, the financial markets would reinforce the Fed's tightening moves by rapidly moving their market rates to where the Fed indicated their terminal rate would be. And the Fed indicates that to the markets from this thing called the dot plot. The dot plot is a plot of the 19 members of the Board of Governors' opinions as to where interest rates will be during the next quarter, the next half, the next year, etc. And these come out as dots on a chart, and the market takes the median dot as gospel. It doesn't matter that over the years, these forecasts have been awful. The market still believes them. When they came out with higher dots, meaning that interest rates were going to go up, the market simply moved very fast to move interest rates to those dots. The Fed might be at one rate and said it was going to go to a higher rate, and the market moved there instantly. Okay. In the time period now where they're going to stop hiking rates or even cut them, the markets are going to move rapidly to these new rates. And the Fed doesn't really want them to do that. That's why their rhetoric has been hawkish. And that hawkish rhetoric worked for a while. And those peaks that we saw in the chart on November 7th and December 28th were because the FOMC members, the Board of Governors, was telling everybody that they're going to continue to raise. But the markets don't believe them anymore. And that's because there's been a meltdown in the inflation data. Almost every day we get evidence of the economy is faltering. And so it appears that something from the past called the bond vigilantes, this is the bond market, has reemerged and has wrested control of the yield curve away from the Fed.
And you said that the reason the market is moving rates down is because the economy is weakening and inflation is melting. But the Fed looks at the labor market and doesn't really see it weakening much. What's your take here?
Yeah, the evidence that a recession has begun is evident, except in the traditional measures of the labor market, like the unemployment rate. It's still at 3.5%. Now, we suspect that the unemployment rate has been sticky. It's not been going up because companies are hoarding labor. And they're hoarding labor because for the last couple of years, they simply haven't been able to find people to work. Instead of laying them off and then worrying that the economy is going to come back and they won't be able to find them, they keep them on. But what they do is, instead of firing them or laying them off, and that is starting, by the way, I'll get to that, they're adjusting to the recessionary climate by aggressively slashing the work week and overtime. That's shown in the charts. Notice that both the work week and overtime are going down. In addition, the headline payroll number that we get every month doesn't distinguish between full and part-time jobs. That data is found in the sister survey, the household survey. And in December, that household survey reported over 670,000 part-time jobs. All of the data, the 283,000 headline in the payroll survey, was all part-time. And that says that the job market isn't as strong as everybody thinks. Then we have almost a daily occurrence, that is a headline about layoffs, especially in the tech world, which is America's growth industry. For example, Amazon laying off 18,000, Alphabet, or known as Google, laying off 12,000, Facebook laying off 11,000, Microsoft 10,000, Salesforce 7,000, and recently laying off 2,500. And today I saw a headline where the toy maker Hasbro has announced layoffs. So we're seeing that it's now moving beyond the tech sector, because we have 3M in there, we have Salesforce in there, and now Hasbro. Like I said, it looks like we get a new announcement of layoffs every day. And a total and comprehensive view of the labor markets leads us to a much different conclusion about its strength than we would glean from just looking at the unemployment rate.
So that's the labor market. Do you have any other data regarding the economy's condition?
Yes, so this chart shows leading economic indicators, and these have fallen for 9 months in a row and in 10 of the last 11 months. And this has never, ever happened outside of a recession. You can see that on the chart. Other data, the monetary aggregates, this is the money supply. Simple money, which is demand deposits in cash, called M1, that's turned negative. That the growth rate year over year is now negative. And so is M2's growth rate, which includes savings accounts, et cetera. It's now negative, and in the history of the series, it has never been negative, not even in the Great Recession. And that history goes back more than 60 years. Banks have reported, and those who have reported so far this earnings season have all told us that they've increased their loan loss reserves by a large amount, double sometimes. So we know where they expect loan losses. We've commented in the past about the rapid run-up that we see in the credit card balances of consumers. And those have occurred because they simply attempted to maintain their living standards. So if gas costs more, it goes on the credit card. If groceries cost more, it goes on the credit card. And those build up the balances. Discover, which is a big credit card company, last week, or maybe it was early this week, announced that they expect that their charge-off rate to go to 3.9% in 2023. That's more than double the 1.8% that they charged off last year. So we see that at least one of the credit card companies is now telling us that this is what they expect. If we look at its earnings season in the stock market, and the companies that have already reported their earnings for quarter four, even though they're, quote, beating the analyst expectations because the analysts have lowered those expectations. If you look at it on a year-over-year basis, quarter four is running minus 10.5% for earnings. That's going to show up in the stock market.
Right.
We have retail sales. We see that for most of the year, retail sales was flat. And then in the last 2 months of the year, in November and in December, we see negative numbers for retail. Minus 1% in November, minus 1.1% in December. And that's a nominal basis. So that includes inflation. That's not good. When we adjust for inflation, real retail sales have been falling at a 2.5% annual rate for the second half of 2022. Not good. Let's talk about industrial production. It fell 0.8% in December and was down 0.6% in November. That's 2 months in a row. And it's been flat or negative in 4 of the last 5 months and in 6 of the last 8. The chart shows the ISM manufacturing Purchasing Managers Index. And this says expansion when the number is above 50 and contraction when it's below 50. And you'll notice on the chart for the last couple of months, it's been below 50. The surveys say in manufacturing saying we're not expanding. And then if we look at the manufacturing production, it fell 1.3% in December and minus 1.1% in November. And capacity utilization, this is how much of their capacity they're using, fell from 79.5% in October to 77.5% in December. They're not using as much of their plant equipment as they have in the past.
That's pretty obvious. Yeah, you also said that the inflation was melting. What evidence do you have of that?
So let's start with shipping costs. The chart I have there shows something called the Baltic Dry Index. Now, everybody should remember that in mid-2021, there were huge port backups. There were pictures of ships waiting to unload, etc. Okay, and during that period of time, as you can see on the chart, shipping costs skyrocketed. But not true today. The Baltic Dry Index, that's this index that peaked here in late 2021, is now down 76% from the peak, and it's clearly the result of fall in demand for those ships. And it's back to normal, and almost, I think it's going to go to where it was during the lockdowns. Weak demand. Now, we also have in those ISM surveys of manufacturer, they survey something called supplier deliveries and backlogs. So if supplier deliveries index is falling, it means that when you order something, you get it right away, as opposed to having to wait 6 or 8 weeks for it, like they did in 2021. It means that the supply chains have loosened. And the same with the backlogs. And the charts on the left show the supplier deliveries, and on the right, the backlogs, and how fast they have fallen. There's something called a prices paid index, and that's the next chart. And it is the prices paid by these manufacturers. And you can see how fast they've fallen. So we see that the prices paid are falling. And in fact, in this particular survey, for every manufacturer that was raising prices, 2.5 were lowering them. So that's another indication that inflation is melting.
Okay.
Now let's talk about the CPI, the Consumer Price Index, and the PPI, the Producer Price Index. These are the popular inflation indexes and the ones that the consumer and the nation looks at. Inflation in the CPI index, if we just look at the past 6 months, is running at a 1.9% annual rate over that time period. Now, the Fed wants it to be below 2% over the last 6 months. It has been below 2%. The chart I have here is the PI, the Purchasing Managers Index. And in December, the PI, the Producer Price Index, I finally got it right, the Producer Price Index fell by 0.5%. This is a very, very big fall. And it's the biggest since we've seen since the lockdowns. The Wall Street consensus, all the economists put together, thought this was going to fall by 0.1%. This was a big surprise. It fell 0.5. That's huge.
Yeah, it is, yeah.
If you look at the core PI, this is X, food and energy. This is closely watched by the Fed. It is down to 4.6% on a year-over-year basis. And we expect that this is going to be 2% or lower by the time we get to June. Then there are these things called rents, and rents have a 30% weight in the CPI. The BLS's way of collecting the data lags reality by 6 to 9 months. If you look at the chart here, you can see the light blue line is the recent real rental indexes that we have, and you can see how fast they're falling. The dark line is the number produced by the BLS for the latest CPI. You can see it tracks the real number, but with a lag. And so we can expect that over the next few months that the rental part of the CPI will begin to fall. The next chart shows the Zillow rental index. You can see again, just like the chart before, rents are falling. And next to it, the chart next to it shows the multifamily units under construction. They're at a record high rate. This reassures us that the rents will continue to fall because this inventory is going to enter the market, and it's a record amount of inventory that will keep the number of units that are vacant high and will force the rents to continue to fall. So we're confident that the rental part of the CPI will begin to fall sometime soon.
That is certainly a lot of evidence that inflation is melting. Do you have any final thoughts, Bob?
Well, the incoming economic data says the recession has already started. The incoming price data says inflation is melting. Since each of these alone presages lower interest rates, together they leave no doubt that even despite a reluctant Fed, we're going to see lower interest rates this year. The last chart is a chart of 49 years worth of history of both the S&P 500 and the Treasury returns each year. On the bottom of the horizontal axis, we have the S&P 500 returns, and if they're positive, they're to the right of the center line. And on the vertical axis, we have the Treasury returns, and if they're positive, they're above the zero line. And you can see that in the upper right-hand quadrant is most of the data, because most of the years, we have both positive returns from the stock market and positive returns from interest rates from the Treasury market. There's a few years here on the upper left-hand quadrant where the S&P, where the stocks did not have a positive year, but bonds did. And then in the lower right-hand quadrant, we have those few years where the S&P stocks did positive, but bonds did negative. You'll note that there's only one point in the lower left-hand quadrant where both stocks and bonds are negative, and that was last year. It was the only year in history that this has happened. When people look at their portfolios and scratch their head, how come we went down? We had a diversified portfolio. The answer is everything went down, stocks and bonds. This year had just begun. And as I showed in the very top chart, we see interest rates are falling. And so we're pretty positive that we're not going to have a negative year this year for fixed income markets. We think that as the recession unfolds, that interest rates will continue to fall. Year to date, they've already fallen, and that's because the market has taken matters into their own hands and has pushed interest rates down. We saw that at the very first charts that we presented here. We think that interest rates at the end of the year will be lower, and that means the bond market at least will have a positive year.
Already, thank you. That's again great insight, very important information to be aware of. I appreciate it, Bob. Thank you everyone for watching. Don't forget to subscribe to the channel and visit Hidden Truths That Today on a regular basis, where we post our videos, podcasts, and blogs every single week. Thank you so much, and see you next time.